Hello and welcome. Have you ever looked at the world of investing and just felt lost? Like, where do you even start? If that sounds familiar, you are in exactly the right place. Today, we're going to pull back the curtain on one of the most popular ways to invest: mutual funds. Welcome to the FinTalk series, where we take on these big, confusing financial topics and make them simple.
I mean, let's be real. The number of choices out there can make your head spin. You've got stocks, bonds, ETFs. It's a lot. And feeling overwhelmed by it all, that's totally normal. But don't worry, we're about to slice right through that confusion.
To do that, we've got a really clear game plan. First up, we'll tackle the big question: what on earth are mutual funds? Then we'll talk about the first choice you'll have to make, which is all about timing. After that, we're diving deep into the main flavors: equity, debt, and these cool hybrid funds. And we'll wrap it all up by showing you how to connect all of this to your own personal goals.
Okay, let's get right into it. We're starting at square one with the absolute fundamentals of what a mutual fund actually is.
So think of it like this. Imagine you're going to a huge potluck dinner. Instead of you having to cook a massive, complicated feast all by yourself, everyone just brings one dish. A mutual fund is kind of the same idea. It pools money from a whole bunch of people, and then a professional fund manager takes all that cash and buys a wide variety of investments. So when you invest, you're not buying one single stock, you're buying units, which are basically your own little slice of that entire investment pie.
Okay, so you have a unit, your slice of the pie. But how much is that slice actually worth? Well, that's where the net asset value, or NAV, comes in. Just think of the NAV as the price tag for one single unit of the fund. It gets a fresh calculation at the end of every single trading day, and that's the exact price you pay when you buy in and the price you get when you sell out. Simple as that.
So now that we know what a fund is, let's talk about the first big fork in the road you'll come across. And interestingly, it's not about what's in the fund, but when you can actually get your money in and out.
And this is a really key difference. The vast majority of funds out there are open-ended. Think of them as having an open-door policy. You can buy or sell your units directly from the fund company whenever you want. Super flexible. But then you have closed-ended funds. These are more like an exclusive launch party. You can only invest during a short window called the New Fund Offer, or NFO. After that, the door closes. If you want to buy or sell, you have to trade your units on the stock exchange, just like you would with a regular stock.
And just so you know, there's also a kind of in-between option called an interval fund. They're not as common, but they basically let you buy or sell units, but only at specific preset times, like maybe once every few months.
Okay, we figured out the when of buying and selling. Now let's get to the really interesting part: the what. What's actually inside these funds? We're going to start with the one most people think of when they hear the word investing: equity. You see, almost every mutual fund is built from three core ingredients. You've got your equity funds, which buy stocks, giving you a piece of a company and a chance for growth. Then you have debt funds, which are more like being a lender, earning a steady income from bonds. And finally, you have hybrid funds, which, you guessed it, are a strategic mix of both.
Now, within that world of equity funds, the first way they get sorted is by company size. You'll hear the term market capitalization a lot. It's just a fancy way of saying the total value of all of a company's shares. Large cap funds invest in the huge, well-known giants. Mid-cap funds go for that next tier down. And small cap funds target the smaller, often faster-growing companies. And this is really important because it gives you a clue about the fund's potential for both risk and growth.
And what's great is that the fund's name is usually your first hint about what it does. A large cap fund, it's required to put at least 80% of its money into those big companies, which usually means more stability. Mid and small cap funds have to invest at least 65% in their respective categories, and they're often chasing higher growth. And hey, if you can't decide, a multi-cap fund is designed to give you a taste of all three.
But wait, there's more. It's not just about size. You can also pick a fund based on a very specific strategy. For example, a sectoral fund makes a really focused bet on one industry, like tech or pharma. A dividend yield fund hunts for stable companies that share their profits with investors. And then there's ELSS, a special type of fund that gives you tax breaks but requires you to keep your money invested for at least 3 years.
Okay, let's move on to that second main ingredient: debt funds. So if equity funds are all about growth, you can think of debt funds as being all about stability and generating a more predictable income. Here, the fund is lending money to governments and companies and then collecting the interest.
Now, with debt funds, the key word to understand is duration.
You'll see a technical term up there, but don't let it scare you. In simple terms, duration just tells you how sensitive a fund is to changes in interest rates. So funds that invest in super short-term loans like overnight or liquid funds have very low duration and are considered really safe. As that duration gets longer, the potential return and the risk starts to climb because those longer loans are more affected by shifts in interest rates.
Beyond just the length of the loan, it also matters who the fund is lending money to. Gilt funds are seen as very safe because they mostly lend to the government. Corporate bond funds lend to companies, which usually means a little more return for a little more risk. And then you have credit risk funds, which take it a step further, specifically lending to companies with lower credit ratings, all in the hope of capturing even higher returns.
So we've got equity for growth, debt for stability. But what if you're thinking, can I have a bit of both? Well, yes, you can. That's exactly where hybrid and goal-oriented funds come in. They mix and match these ingredients to create balanced portfolios for specific outcomes.
And what's cool about hybrid funds is they let you customize the balance based on how much risk you're comfortable with. A conservative hybrid fund is going to be mostly packed with the stability of debt, with just a little bit of equity sprinkled in for growth. On the flip side, an aggressive hybrid fund cranks up the equity for higher potential returns, using just a bit of debt to smooth out the ride. It's all about finding that perfect blend for you.
And some funds make it even easier by literally naming the goal they're built for. These are solution-oriented funds, designed for those big life moments. Now, they often have a lock-in period, which might sound like a downside, but it's actually a feature. It's designed to help you stick to your plan and not dip into the money early, making sure it's there when you need it for, say, retirement or your kid's college education.
So when it all comes down to it, picking the right fund isn't about throwing a dart at a board. It's actually a pretty straightforward three-step process. First, you have to know your goal. What are you saving for? Second, you need to think about your timeline and your comfort level with risk. And third, you just take those answers and use them to find the category we've talked about that fits you best. It's that simple.
And that really brings us to the final thought for today. Now that you have the roadmap, what's your first destination? Just take a second and think about it. What is the very first financial goal you want to start working towards? Because answering that question is the real first step on your investment journey.
Thank you for listening to this FinTalk episode. We really hope this has helped make the world of mutual funds feel a little less mysterious.